Ancient Rome wasn't just a cultural and military powerhouse, it also boasted a sophisticated financial system. Investors like Cicero, Seneca, and Crassus employed strategies that remain relevant even today. Yes, you heard that right. Even after 2000 years, some of those principles are still applicable today, and that's the point of this video. I want to show you that investing principles don't change a lot over a period of time, even over thousands of years. I'll show you how these principles are still being used by some super investors and why you should apply them too. If people in ancient Rome were applying them, you have no excuse to not apply them today. You have a technological advantage over all of them. You and me have access to so much resources now that we can take these principles and apply it to very sophisticated strategies. I've been wanting to make this video for a very long time. My life has been molded a lot by Roman philosophy. As you'll see in my background, this book by Seneca is a book that I read quite often, almost every week once. I just try to read a couple of letters from Seneca just to remind myself the principles I follow on a day-to-day basis. But today we are just going to look at the investing principles. Let's begin. Before we begin, nothing in this video is financial advice, at least not from me. It's advice from the great Roman statesmen and philosophers. The first three lessons we are looking at today are directly coming from Cicero. He was a renowned Roman statesman, orator, and investor. The first lesson he's teaching us is to diversify our investments. Even 2000 years ago, he used to have a very well diversified portfolio, something that we hear from super investors all the time. He owned properties in Rome, Pompeii, and many other places. He also invested in farms and vineyards in Italy and Sicily. He funded trade expeditions, lent money to merchants, and invested in share pools of fleets. He was a very smart investor. He diversified his portfolio in a way that he could take advantage of economic cycles even back in the day. His real estate investments protected against inflation and market fluctuations. Yes, inflation was a big problem even back then. Today, it's a very big problem, and that is why we must all invest. Then, agriculture investments provided a steady income stream, balancing his portfolio during economic downturns. You could think of this as dividend stocks that you may own today. You might be getting paid for owning them even during bad times in the market. Investments in commerce and trade expeditions capitalized on the Roman economy's growth. Other than that, he was also lending money, which provided him with interest income. Even the way he was investing in fleets, it would spread the risk across multiple ships and trade routes. Even today, your income should be generating you more income. It could come in the form of you getting interest for keeping your money in a high interest savings account. It could also be because you're buying into bonds or GICs. There are also other ways that you could be generating income. Other than that, you should have a diversified portfolio. You should own stocks, ETFs, gold, and even Bitcoin if possible. The point is to have a well diversified portfolio no matter what the times are. Similar to Cicero, your goal should be to not have over dependence on any one sector. One of the best examples of this in the modern world is Warren Buffett's Berkshire Hathaway. Even though Warren Buffett says diversification is protection against ignorance, it makes little sense if you know what you're doing. Berkshire Hathaway is actually well diversified across industries, from insurance to energy to consumer goods. So what does that quote actually mean? It means that you shouldn't be over diversified either. You shouldn't be so ignorant that you have to invest in every single thing. Realistically speaking, you cannot be good at everything. So you have to pick and choose and create a well diversified portfolio within your expertise. And much like Cicero, Warren Buffett has also weathered several economic downturns and generated consistent returns over the decades. When we were discussing Cicero's portfolio, you might have noticed that he had a heavy inclination towards income generating assets. This is because one of the key lessons we learned from him is to always consider liquidity. Cicero's investments in share pools of fleets provided liquidity and flexibility. He received earnings from each voyage, ensuring a steady cash flow and allowing him to seize new opportunities and handle unexpected expenses. So basically what this means is that a certain part of your portfolio should always be sitting in cash. If the cash is not there, make sure it's coming from somewhere else pretty soon. Even in my portfolio, I always make sure that at least 10 to 15% is sitting in cash just to jump on opportunities that might come along. Nowadays, a lot of people have a habit of going all in with no money sitting on the sidelines, which is not a good thing. Especially stock markets are quite volatile in nature, but you may not even have the money to get in when the downturn comes. This is actually proven by Ray Dalio's all-weather portfolio that demonstrates modern liquidity management. He has often said, cash is trash, but cash is also very important to have. Cash is actually a very critical component of an all-weather portfolio. This is again to jump on the opportunities that might come along. For example, there are several macro factors like wars that you have no control over. Often when somebody attacks somebody else, you might see a sudden downturn in the market. This is the opportunity we are talking about. These are very short-lived and should be capitalized on. You should always be thinking of cash as an asset. It's a capital preservation asset. An all-weather portfolio balances growth-oriented assets with capital preservation assets and cash, allowing investors to rebalance during market shifts and take advantage of opportunities that we have spoken about. The reality is that most people, almost 99% of the people, cannot see a downturn coming, and you may not see it too. So always be ready to jump on these opportunities. This is why it's so important to consider liquidity, as Cicero has advised. 2021 is a great example. There were so many investors who were fully invested in the market. When the inevitable downturn came, a lot of people did not have enough money to capitalize on the opportunities. They had to wait for their paychecks or wait to raise more money until they could get into the markets again. Even during these times, if you have some income generating assets like dividend stocks, you might be able to raise some capital to buy other stocks. Just consider all of this when you're preparing your portfolio. I'll remind this again, a lot of people will often say cash is trash because of inflation, and it's true. But remember, when assets fall down, the cash in your hand actually becomes way more valuable. And this is why it's so important to pay at least some attention to what's happening in the market and in the macroeconomic environment. And of course, investments play out over a very long term, and this is when the third lesson by Cicero comes in very handy, and that is to stay focused and patient. Cicero always maintained a long-term perspective and disciplined approach to investing. He made decisions on forward-looking analysis rather than short-term market fluctuations. This is actually very true today, where people just keep chasing immediate gains in the market. They are thinking so short-term. Cicero remained patient and avoided knee-jerk reactions even during times of political or economic uncertainty. These are excuses I hear all the time. People say things like, the elections are coming up, so I have to wait until I can find out who wins and then I'll enter the market. Or a war just started and now they're waiting for things to get better before they can invest. Before you know it, the opportunities are all gone and you are fixated on the wrong things. This is also another reason why dollar cost average is the best method for an average investor. You periodically keep buying when you have the money and just forget about it. Basically, there are some investments that you should be doing all the time. For example, the S&P 500 is something that you should be buying irrespective of what's happening out there. Historically, it's been shown that people who try to time the market actually underperform people who are consistently buying by dollar cost averaging. Somebody who has actually exemplified this in modern investing is Charlie Munger, rest in peace. He says that the big money is not in the buying and selling, but in the waiting. A very good example of this is Coca-Cola. Munger and Buffett actually held this stock for decades before reaping significant returns. If you have patience and a long-term focus, you will not worry about the everyday market volatility and you can just stay focused on the long-term aspects of it. Even 2000 years ago, Cicero was thinking long-term. Even though the lifespan was lower, he was still thinking long-term. He was never thinking about how can I stop doing it as soon as possible. He was always thinking how can I continue doing it for a very long time. Even for a lot of us, we are consistently thinking how can I retire or become financially free in the next 5 years. That's actually something that's very hard. There are very few people who actually achieve it, and it's actually much more difficult for people who actually do regular jobs, get paid and invest their money. For people like us, wealth preservation is important and you should just focus on building your wealth over a period of time. The next lesson that we are going to learn is from Crassus. He was one of the wealthiest individuals in ancient Rome and he invested in emerging markets. Yes, I said emerging markets. Pretty exciting for all the tech, AI, and crypto investors out there. And yes, even 2000 years ago, people were looking for emerging markets because even back then they knew that that's where you can make the most amount of money. Crassus actually funded Roman glassmakers to export their products to growing Chinese market, leading to significant returns. As you can imagine, this came with a lot of risk because shipping glass products all the way from Rome to China was not easy. But the point I'm trying to make is that emerging markets always have more risk than regular markets. Jim Rogers is actually somebody who focuses on emerging markets in modern times. He always says the next century will be the century of China. But he doesn't just invest in China, he invests in the Asian markets. He may be right or wrong about these markets, but that's where the risk reward lies. I have a few friends who invest in Chinese markets, but they're fully aware of all the risks they're taking on. Another great example of an emerging market is actually India. There's so much potential there, but there are definitely some unknowns. People who invest in emerging markets often tend to invest in commodities because they can benefit a lot from emerging markets. Something to keep in mind if you're interested in emerging markets. The last lesson that we are going to look at today is actually from Seneca, and it's to manage your risk wisely. Seneca used to emphasize a lot on the importance of risk management in investments. He advised, it is the part of a wise man to keep himself today for tomorrow and not to venture all his eggs in one basket. So what does this mean? Basically, don't go all in, and especially don't go all in into one single asset. All the other lessons we have looked at today actually inherently assume this, that you're managing your risk wisely. Howard Marks Marx is actually somebody who applies rigorous risk management to modern investing. He says risk means more things can happen that will happen. I absolutely love this quote. Risk means more things can happen than will happen. This is something that actually applies to life as well. Basically, you should be prepared for a lot more things that will happen. One road can lead to many different roads, and until that point comes, you don't know where you are going. So it's better to stay prepared even if you don't need it. And that is why I said this also applies to your life. Marx focuses on understanding and controlling risk in Oaktree Capital's investments and emphasizes the importance of assessing potential downside risk and investing with a margin of safety. Even for us, we should always consider the risk-reward ratio. For example, if you're buying stocks like Amazon, Google, and Microsoft, the risk of these going to zero is almost zero. But if you're buying something like a meme coin or a meme stock, the probability of it going to zero is actually quite high. You need to understand this curve and make sure that you apply it to your investing. So there you have it, a short video about what we can learn from the Romans about investing. As Seneca rightly said, luck is what happens when preparation meets opportunity. And the 5 ancient Roman lessons we looked at today will help you stay prepared so that when the opportunity presents itself, you're ready to jump on it. In short, remember to be prepared, keep some cash on your hand, manage your risk, and always seize the opportunity when it presents itself. On that note, I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.